Well, that's a very good question, and it's a very relevant question at the current juncture. Inflation is very elevated globally, so central banks are tightening monetary policy, and an intended outcome of the tightening of monetary policy is to tighten financial conditions. So we have seen that interest rates have increased, interest rates on mortgages, for corporate credit, and equity markets and risky asset prices have gone down. All of these are intended consequences. But of course, what central banks try to achieve is an orderly tightening of financial conditions. And at the moment, what we're seeing are pockets of dysfunction. And that is very concerning for central banks. This is when central banks step in order to restore orderly market functioning.
I love the way you've neatly avoided referencing Lehman. But the concern is that these things just don't blow up in one go. You get some tells before that, and it starts with markets which are drained of liquidity being unable to process business. The IPO market is shrinking rapidly. We're seeing all sorts of dysfunction in the bond markets at the moment. Some of it, clearly, the UK Chancellor is responsible for. But a lot of it perhaps is nothing to do with the gilt market. It's a fact that we are seeing liquidity drain. So let me ask you again, are we, do you think, on the precipice of anything very significant in credit markets at the moment?
Our baseline is one where things continue in an orderly manner, but there's a lot of risk to the downside. So there are financial stability risks to the downside. We have one very nice chart in the Global Financial Stability Report where we are quantifying the magnitude of downside risks, the financial stability risks that you're alluding to, and those are very elevated. They are only higher in times of acute crisis, such as the 2008 crisis, the 2020 COVID crisis, or the Euro crisis. So yes, we are in a very, very stressed moment. We do hope that we will avoid a systemic event, but the likelihood is certainly elevated at this point.
And where is that likely to emerge if it does arrive? Will it come out of the gilt market? Will it come out of a large financial institution, maybe a regulated bank, or maybe a less regulated non-bank financial business?
Well, the good thing about the banks is that they have a lot more capital than they had in the 2008 crisis, right? A lot of the acute stress in the financial system in 2008 was actually in the banking system, right? And so now we have banks that have a lot more capital, and that's a very good thing. That doesn't mean that there couldn't be certain stress and there couldn't be spillovers from the market-based system, from the non-bank financial system into the banking system, but banks generally have fairly high levels of capital and liquidity. Now, having said that, we do flag that in emerging markets, even the banks are somewhat at risk. So under a severely adverse scenario in emerging markets, about 30% of banking assets would be undercapitalized. So that is certainly a cause for concern. And of course, as you're alluding to, in the non-bank financial system, there are many vulnerabilities. There's leverage, there's maturity transformation. Oftentimes, this is hidden. It's very difficult to see, and there could be spillbacks from the non-bank system into the banking system.
What we've learned about the gilt market and the pension fund industry is that it's not as staid and perhaps relaxed as we'd expected. We're finding derivatives are being employed to generate leverage on margin. Right. Again, shades of 2000 here. Do we need to thoroughly now stress check more parts of the financial economy to make sure that there are not risks buried there?
Well, that is exactly one of the recommendations from our financial sector assessment in the United Kingdom that was released just a couple of months ago. So we are actually recommending to collect more data of the non-bank financial system and to look at those regulations and potentially tighten them in order to constrain